Good morning, everyone. My name is Christina, and I'm with Atlantic Institute. We are here with our Life Skills for Teens class, and this month we are learning how to use a credit card. And who we have with us is Matthew Fowler, and he is the branch manager of First Citizens Bank in Livonia, Georgia. And so, Matt, if you could share with us some of your knowledge, we would really appreciate it.
Yeah, I'd be happy to help. So I have been, just a little bit about me. I have been in banking for nearly 10 years now. So I've been helping individuals and clients get started building credit. I've helped them, buy their first car. I've helped them buy their first house. I've helped them refinance, help with retirement planning, kind of the full spectrum of the finance world. And throughout all of that, piece, I continually find, even people in their 30s, 40s, and 50s that still don't understand how credit works or how credit cards work. And so I really appreciate you having me on to talk about this. It's a great opportunity for you to learn at a young age kind of how credit operates, how to use it for your favor, and how to avoid trouble, different ways that you can take advantage of opportunities. When it comes to our world now, credit is one of those things that it's necessary for a lot of aspects of our life. For buying a car, a lot of times you're not able to save up enough cash to do that. You have to go out and come to a bank, come see a guy like me at the bank and say, I need to borrow some money to go get my car, to get back and forth to work, to get back and forth to church, to get back and forth to live life. And one of the first questions we're going to ask is, have you ever borrowed money before? Do you have a credit score? Do you have a job? Questions like that all factor into what we call your ability to repay. And when it comes to credit cards, they can be one of the most advantageous ways to establish credit, build credit. They're usually the first step for a lot of people to get started, because they're generally the easiest to get when it comes to credit. The world of credit cards can be dangerous, though. I want to tell you that up front. I've seen nightmarish situations where families have racked up, a lot of debt, and credit cards are considered the highest rate debt that's available to you generally. Most interest rates are going to be, around 20% or higher. 21's the national average for credit cards. But I kind of want to just go through what a credit card is, how it works, how to get one, some of the factors that play into that, how to use it effectively. And so I actually did do a little presentation. So I'm going to share my screen here if I can figure out how to do that effectively.
And that's something really good to use because my daughter's 20 and I keep telling her she needs to build some kind of credit so she can qualify for things on her own as she gets older here and grows up.
Yeah. So it is telling me that I have to open system preferences and grant security and privacy access to this. So let me see if I can do that real quick.
Interesting. You must not have done that before because I know on here we have, when you hit share screen, you pick your other screen.
Right. Yeah, it gives me the option to do that, but then when I click on it, it tells me I have to give permission. So
you gotta love Zoom.
Yeah, I've never used Zoom on this computer before. I usually always
use why.
I usually always use my office computer.
So for those of you in the meeting, can you guys drop in your ages so that we can kind of get to know what age range we're talking to here when it comes to getting a credit card? That would be great. Onyx is 19. And if we can get everybody else, I know my daughter is 20 she's on my phone plan and she's on my auto insurance. And there's a few things I've told her. I've said over time you need to transition to your own, because I said that would help you to get some of your own credit, because that's what people look at when you want to rent something and different things like that. All right, Riley, not a teen. Good to know. Roma is here for her 12-year-old nephew. And Yuri, if you could drop in there and let us know how old, what the age range is.
It is wanting me to quit Zoom and reopen it to be able to share my screen. So
if you want to, you can do that.
I did do a presentation. I think it would make it a little bit easier to understand. So let me see if it'll let me do that.
Yeah, that would be fine.
All right, I'm going to leave the meeting and I'll jump right back on.
Yep, no problem. All right, so if we could get Roma, we have Riley, Onyx, and let's see, Roma. Yes, you're from Canada. And Yuri, and then Argelia. Earlier when everybody came in, I asked them if they could put in the chat where they're from. That would be great if you could. Put in the chat where you're from and what age range that we're talking to here. 16 and 14-year-olds. Awesome. Unfortunately, I will tell you, by 12 and 14 and everything, it is important for some of these youth to start learning how to be an adult and how to be able to do these things. And they really, in order to get a good start in life, that they really need to pay attention to finances from the beginning. I mean, it's kind of really an important thing. So I will tell you, my oldest is adopted from foster care. And one of the things that they do in foster care after the child is over 16, they actually have a liaison person that pulls their credit up and clears anything up on their credit, because their biological parents or relatives could be using their credit as a child for their electric bill and for all different kinds of things. So it's really important to look for that they'd even do that. It's kind of interesting. Welcome back, Matt.
Thanks.
All right.
Sorry about that.
Let's see if this works.
All right. I think it should be okay now. Let me.
I thought it was quite interesting that they provided that service for 16-year-olds and up in the foster care system, because
It is
parents do, like if your electric bill's close to getting cut off and you just let it get cut off, you open up in somebody else's name, you open it up in your kid's name.
Yeah.
It's kind of what the common thing is. And then they don't pay that bill and then that gets shut off. And then by the time the kid's 18, they've got bad credit already. So
yeah, it's considered identity theft technically, but
yep.
It is wanting you to enable me to screen share.
Oh, yes. Now I have to make you a co-host again. Hold on.
Sorry about that.
Nope, that's okay. Yeah, Roma, I thought that was actually really great that they put that in place, because that's something that foster parents and adoptive parents shouldn't have to deal with.
Yeah, for sure. All right. Can y'all see that?
Yep.
Perfect. So I kind of wanted to start with an explanation of what a credit card is, because I didn't know what level of understanding there might be there. So I'm sure if you're 18, you probably have had a debit card of some kind or have been sent to the store with your parents' debit card. So a debit card essentially is an access card that allows you to access the funds that are in your checking account. What a credit card is it's an access card that allows you to access a line of credit. And that line of credit is what they call a revolving line of credit. And what revolving means is that if you have a $1,000 limit and you use 300 and you repay that 300, that 300 becomes back available to you. And so that's what they mean when they call it a revolving line of credit. So as you use it and as you pay it, it becomes back available. Credit cards are issued by creditors, banks, financial institutions. They look almost identical identical to a debit card, but they do function very differently. Debit cards, you don't have to make a payment on the money that you use off of it because it's already coming out of your money. It's cash that you're spending. Whereas a credit card is debt. It is where you are using someone else's money to make the purchase, and then you're going to get a bill for that balance that you've used. There are 4 major credit card processors. There's Visa, Discover, MasterCard, and American Express. So if you look on the bottom right-hand side of most all cards, it'll have one of those 4 logos on there. When you get it overseas, there are some additional ones, but those are the 4 major U.S. creditors or processors. And if you even look at your debit card, like a First Citizens debit card, we have a contract with Visa. So Visa actually gets a percentage of every single time you swipe your debit card. That merchant is paying a fee for that card to be swiped. Visa's getting a percentage of it, and the bank's getting a percentage of it. It's kind of interesting to know that when you swipe a debit card, it actually isn't cash. It actually does cost the merchant something generally. And that's why you see a lot of merchants starting to charge to accept cards, which technically they're not allowed to charge to take a debit card. But the card allows access to a revolving line of credit. Lines of credit can change or be anywhere from a few $100, $300, all the way up to hundreds of thousands of dollars for those who have substantial assets or, cash. A lot of times the banks will give them a credit card with a really, really large credit limit to allow them to use that instead of their debit card. How do you get one? So credit cards are an application-based system. So to get any card, you're going to have to go to a bank. You're going to have to go to an online creditor like Chase, Capital One. You'll see their commercials all the time, and put in an application. When you put in that application, they're going to pull what they call a credit score or a FICO score. That FICO score, that credit score, is going to be pulled from 3 places. There's 3 credit bureaus in the U.S. that we utilize to basically monitor and assign a credit score for individuals. That's Equifax, Experian, and TransUnion. If you meet their underwriting criteria, and when you apply for any credit, your application goes to what they call an underwriter. That underwriter is going to look at their criteria for issuing credit and say, okay, do they check the box for our credit score? Do they check the box for our debt to income? Do they check our box for employment history? Do they have too much debt? Have they used their other cards effectively? And based on all of that information, they're going to say, issue an approval or a denial. If you get a denial, you're going to get a letter in the mail. It'll generally have your score on there that was reported to them from the credit bureau, and it'll give you about 3 to 5 reasons why you were denied. Generally, those denials are going to be reasons for credit score below minimum or reasons inside of your credit score why it was low. If you had late payments or if you had too high of utilization on your credit cards, or if you have too much debt, if you have too many monthly payments that are more than your income can support, they're not going to issue additional credit. This is a business for these places. This is not a favor that they're doing you. This is not just something that everybody is entitled to. This is something that you have to earn. It is something that you have to work to be able to be a good steward of your finances to qualify for these. The better steward you are, the better criteria you're going to get. If somebody with an 850 credit score goes and applies for a credit card and they don't have hardly any debt and they have good income, they may get a $25,000 credit limit with a 12% interest rate. If you have somebody with a 620 credit score go and apply, they may get a $500 limit with a 23 or 25% interest. because they're a higher risk to that lender than that person with an 850 credit score and good income. So based on your risk to that institution is how they're going to assign interest rates. It's how they're going to assign credit limits, and generally the type of cards that you're going to be able to qualify for. There's a bunch of different cards out there. There's a bunch of different rewards cards. There's a bunch of different non-rewards cards. There's a bunch of cards that have annual fees. Some don't. There's a whole range of credit scores out there, anywhere from, I think it starts at 400 and goes all the way up to 850. Generally, to qualify for a credit card, you have to have kind of a minimum of about 620. That's kind of what you have to qualify for just about any credit, whether it's or any loan, whether it's an auto loan or mortgage, credit card, unsecured loan, any kind of debt. Generally, the bank or the institution is going to look for at least a 620. Most things that are what they call unsecured, which means that you're not putting up any type of collateral for that debt or for that loan, is going to be more like a 680 minimum or a 660 minimum versus that 620. 620 is generally for mortgages, for auto loans, for what they call collateralized loans. So basically a loan where the bank's going to have some kind of asset as collateral for the loan. Most people, when they're 18, 19, you haven't ever borrowed money, you don't have a credit score, you may have a low income because you're just getting started in the employment force. So when you go to apply for a credit card, you're probably going to get denied. You may not get qualified for one. And depending on how the economy is doing, creditors will tighten or loosen their restrictions for credit, which is kind of interesting. So you'll see in times of really good economic numbers, they'll say, okay, well, we're going to lower our credit limit. We're going to lower our credit score to qualify. We're going to lower our standards a little bit and allow more free flow of cash flow to people. And during those times, a lot of people are able to qualify without much history or without a high credit score. The challenge that a lot of people have when they're young is getting that first card, because until you have a card or you have an auto loan or you have some kind of loan outstanding, you're not going to generate a credit score. So when you come to me and I pull your credit, it's going to come back with zeros, no history, and then we're going to issue a denial. We're not going to be able to do a credit card for you. And the alternative to that is what we call a secured credit card. And what that is basically is where you put up cash. So generally it's like $300, $500, or $1,000. You put up cash and we put that money into a savings account. We lock that savings account and use it as collateral to issue you a credit card with that limit. So if you put up $500, we'll usually give you a credit card with a $500 limit. You're able to use that card just like a normal credit card for usually 12 to 18 months, sometimes 2 years, depending on how you're utilizing it. And if you utilize it well, if you show that you can be a good steward of that card, they will eventually move that card to an unsecured card and release those funds that were collateralized. Or eventually you can get a score high enough to where you can go and apply for a new unsecured credit card through some of other financial institution or even from that bank. The secured credit cards are probably the most common way that folks are getting started with credit. The other way is with a cosigner. So if you have a parent, if you have a relative, grandmother, grandfather that has good credit, they can add you as an authorized signer to one of their existing cards. And that's a really, really good, effective way to get started with credit. And it allows somebody to help you monitor your usage. Because with credit cards, as I started out with, you can get in trouble really quickly with building up too much debt on a card and only making minimum payments. And then you get to where you aren't able to ever pay it back because the interest accrues too much. And so having a good relative mom, dad, grandmother, grandfather go on a card with you and help you monitor it and make sure that you're not spending too much money, make sure that you're using it effectively, make sure that you're paying it off in full every month, is a great way to get started if you have somebody in your life that's able to do that. If you don't, the best way is that secured card generally. I like to highlight Dave Ramsey in most of my financial classes that I teach, and he's got his own way of thinking about finances, but he has a website. He has a ton of tools available on his website, and I'm going to reference one of those in a little while that allow you to learn about credit, what to do, what not to do. He is not a big believer in credit cards. He highly encourages you to stay away from them. The unfortunate reality for a lot of people is it's really hard to establish credit without getting one. The thing that you have to do is make sure that you are diligent, that you are using those cards effectively and not putting yourself in a poor financial position by spending money that you don't have, which is what a lot of people do with credit cards. They'll see something nice that they want, or they'll have an emergency. They have this card with a few $1,000 limit. They'll pay for that emergency or that thing that they want, and then they'll make minimum payments for the next 12 months, 2 years, 3 years, and it just carries on, and that balance continues to get bigger and bigger because they can't afford to repay it. And Dave Ramsey, he calls the credit score the I love debt score, because the credit score is simply a number that's assigned based on your history with debt. So your history with loans, your history with credit cards. And so the only way to build it is to use it, which I encourage you to utilize it, because it makes things much more affordable when you do go to buy a car or buy a house. If you have, again, just like I gave you the example of the high credit score allowing you to have a lower interest rate, the same with a mortgage. If you go to apply for a mortgage, you can qualify for a much better interest rate on that mortgage if you have a good credit score than if you don't. And that kind of thing, especially when you go to buy a $200,000 or $300,000 house, makes a massive difference in your monthly payments. It makes a massive difference in the amount of interest that you're paying the bank. You know, that 1% difference between a 650 credit score and a 700 credit score makes a big difference in your monthly payments on a few $100,000. And so it's really good and really wise to get started early, to build that score effectively, and to manage and monitor your credit score. And I'm going to go over a way that you can do that later as well.
I was going to add to that, actually, your auto insurance rate can fluctuate, I think, depending on your credit score as well.
It can. So as of like last 5 or 6 years, insurance companies have really started utilizing credit scores as an indicator for risk, because it is somewhat of an indicator for risk. It's a reflection of your integrity, your character, and in some instances your financial wisdom when it comes to managing your funds. And so folks who are generally good stewards of their funds, pay their debts, pay their payments, manages their money well, saves money, they're going to be a lower risk for insurance claims than somebody who racks up a lot of debt, doesn't pay their bills, and potentially lives a lifestyle that is not conservative in that aspect. And so they rely heavily on that, and it can impact a lot of different financial aspects when it comes to your credit score in saving you money or costing you money. Same with student loans, same with unsecured debt, home improvement loans, home equity lines of credit, all of those things. So how you're billed. So I kind of wanted to go over statements, payments, and interest. So as I mentioned, a credit card is an access to a line of credit. That line of credit has what they call an APR assigned to it. So that's your annual percentage rate, which is it's almost interchangeable with interest rate, but it's a little different. But your annual percentage rate is your total cost of borrowing on that line of credit. The average APR on a credit card is 21%. And every single month that you put money or you use that card and let's say you have a $3,000 limit on a credit card, you put $1,000 on that credit card and you have a 21% interest rate. Your minimum monthly payment is going to be 3 to 5%, depending on the credit card company, of that balance. So, on a $1,000 limit, you may only have a $30 minimum monthly payment. But that $30 minimum monthly payment is barely going to cover the interest that's due on that, because the interest for that month would be about $17, $18. So you're only going to have about $12 of that go to the actual principal. So then the next month, you're going to have a balance of $988 because you only had about $12 go to principal. And then you pay interest on that $988, which is going to be like $17. And then you make another minimum monthly payment, and you can carry those minimum monthly payments for years and years and years. And I've seen people do it. I've seen people rack up $10, $15, $20,000 in credit card debt. And the next thing you know, they're 7, 8 years into it, and they have barely paid back any of the principal that they borrowed. And there's a lot of tools and ways to get out of that. But the problem that they have, and a lot of times you get into, is when you put yourself in that position and you get close to your limits on credit cards. So if you have a $3,000 limit and you get $2,000 on that card, it's going to hurt your credit score. It's not going to help your credit score. So even if you make a regular monthly payment every single month, if you're not paying that balance down to what they consider a good utilization of the limit, it's going to hurt your credit score far more than it's going to help. So what the credit system looks at is, what percentage of the limit are you using? And if you're using more than about 30% of your limit, it's going to hinder your score far more than it's going to help. And if you get over 50, it's going to hurt even more. And if you get close to 80 or 90% of your limit, it's really going to tank your score. So, you might have a $3,000 card and a $5,000 card out there, and your credit score is 720. You have no balance on those cards. You go out and use $4,000 on the $5,000 limit and $2,000 on the $3,000 limit card, and you have $6,000 in debt, but you're at 80 or 90% utilization on those cards, and your score is going to fall from 720 to 660 potentially. And then it makes it difficult to qualify for a different type of fixed loan at a lower interest rate, so that you could pay those cards off with a lower interest rate. And so once you get yourself in that position, it can be difficult to dig yourself out of it. And so it's better to stay diligent and not get yourself in that position to begin with. So there's a neat little interest calculator on NerdWallet. If you're not familiar with NerdWallet, it's a really great website that you can utilize for a lot of financial wisdom. You can go to NerdWallet and find information on just about everything, whether what credit card to get, how to calculate interest on it, how to qualify for loans, what's a good credit score, how to bring your credit score up. They have articles and blogs on a lot of different financial information. And they have a neat little calculator that'll let you calculate how much interest would be on a certain type of balance on a credit card. I did want to kind of go over what a statement looks like. So this is basically an example of a credit card statement. So this is John Doe. He has put, if you look in the top right-hand side, $1,234.56 on that card during this month. His minimum monthly payment is $25. You can see where he had a previous balance of $900 and made a $900 payment, which means he didn't pay any interest. So that's the benefit to cards a lot of times, and why a lot of people will utilize them, because you can utilize them effectively without accruing a lot of interest. So if you put $900 on a credit card and you pay $900 off when the statement comes, they're not going to charge you any interest. But if you put $900 on that card and you pay $400 towards it, you carry a balance of $500, you're going to pay interest on that balance. but you can see here where it's going to show, the purchases, new balance, available credit. This is something else. Most credit cards will give you what they call a cash access line or a cash advance balance. So most cards will give you what they consider a limit. Let's just say your limit on a credit card is 10,000, like this one is. You may have what they also call a cash access or a cash advance line. That balance is generally lower, or that limit's generally lower. So this one's 2,000. What that means is you can take that card to an ATM and pull $2,000 in cash out to go and make a cash purchase if you need to. The things to keep in mind, and I've never done this, but the things to keep in mind with a cash advance, the interest rate is generally higher on a cash advance than it is a standard purchase. So if you go and use your card at Walmart for an item, you may be at 21% interest, but then you go to use it in ATM and pull cash out, it may be at 28 or 30% interest. It's generally 7, 8, 9, 10% higher for a cash advance than a standard purchase on a credit card. That's just kind of one of the ways that they get you. But if you look down here on the second page of the statement, it's going to show the transactions. It's going to show the total year to date. It's going to show the total fees and the total interest that has been paid in 2019 for this individual. But if you look down here at the very bottom, you're going to see where the purchase interest rate is 15.99 and the cash advance interest rate is 22.99. Something else that cards do allow you to do is a balance transfer. So a lot of cards will advertise or give you a promotional time frame where you can do a balance transfer at 0% interest. And basically what their goal is for you to transfer that balance over to them, take advantage of the 0% interest, and then not pay it off in the time frame. So a lot of times it's 12 months, sometimes it's 18 months. If you go to Best Buy, a lot of times, I worked at Best Buy for a long time, and they really, really push their sales associates to sell the credit card. And one of the ways that they sell the credit card is with a promotional 0% interest. So you go buy that $1,000 TV, you put it on the Best Buy credit card, they give you 6 months, no interest. But what a lot of these places will do, Home Depot does it too, if you don't pay that balance off in full in that 6 months, not only are you going to start getting charged interest, you're going to get charged the interest that accrued during that whole promotional time frame. So, if you put $1,000 on that card, you carried the balance for the full 6 months, and you only had $100 left at the end of the promotional time, they can back charge you all of the interest for that full 6 months. I've had that happen before on a Best Buy credit card. That's how I learned about it back when I was working at Best Buy 15 years ago now, before I got into banking. And that's not a conversation you want to have with a creditor when they back charge you $500 in interest on a $1,000 purchase or a $1,500 purchase. Can definitely ups up your apple cart. One thing that I did want to go over as well is the different kinds of cards. These were just a few that I could think of off the top of my head. So there's a lot of different rewards available to you. And that's one thing that a lot of people will sell you on, is the rewards for credit cards. When you go to use a card, or go to qualify for a card, you can qualify for several different kinds of rewards. You can get cash rewards. A lot of times you'll see them advertised 1% back on everything, or 1.5% back on everything, or 3% back on gas and groceries, 2% back on travel, 1% back on everything else. And they'll categorize it to give you incentives. There's certain companies that will also do deals sometimes, like I have a Bank of America credit card, and what it allows, or what it has on there, sometimes when you go to look, is they'll say, if you go to Target, they'll give you 5% back, or if you go to Home Depot, they'll give you 5% back. They'll give promotional rates for cash back at certain different places. A lot of cards will also give you promotions to sign up. Like if you use $3,000 in the first 3 months on the card, they'll give you a $100 bonus in cash back, or they'll give you I've seen as high as $1,000 back in cash if you spend up to a certain dollar amount. Those are the really higher end cash rewards cards. The thing you have to watch out for a lot of those with is an annual fee. which I'll get to on the next page. Some cards have annual fees assigned to them. So every year you're going to pay a fee to have that card. A lot of times those are your higher end cash rewards cards or your higher end airline miles cards. Every time you go get on a plane, you're going to see that stewardess do the presentation about the JetBlue credit card or the American Express. American Express credit card or their United Airlines credit card, and they're going to try to get you to sign up for that promotion they're running where they'll give you 40,000 bonus miles or some type of incentive to get signed up. This is a very booming business for banks. I think it was something like $107 billion was paid in interest in 2021 to the banks. So this is something that the banks make money from. It's not something that you usually make money from. A lot of people will sell you on, you get signed up, you get your $100 cash back, and then you can take advantage of your 1 or 2% cash back. But if you pay interest on just 1 month's interest on a decent sized balance, you're going to be losing that battle very quickly. So I highly encourage, when you get your cards, and I do have credit cards myself. I do encourage people to have cards. They're extremely handy for certain situations. It's good to be able to establish and build credit with the credit card. But be extremely cautious and extremely careful that you aren't putting yourself in a bind or putting yourself in a poor financial position by spending money that you don't have. The rule of thumb is if you don't have it in the bank to pay for it, you generally don't need it, especially if it requires you to pay for it with a credit card. So usually what I tell people when they go to get cards at the bank from me is, only use it on the money you have in the bank. Use it just like a debit card, pay it off in full every single month, and then you can win on occasion by getting those cash rewards back, taking advantage of the cash back and not paying interest. Some of the fees that you'll find on credit cards, you'll have a late fee that's assessed if you don't make the minimum monthly payment by the minimum monthly payment date. So if your payment's due on the 21st and you make a payment on the 22nd, they're going to assess a $35 late fee. That late fee can be anywhere from $20 to $50 to $100, depending on the company. But the average is generally about $35 that I've seen. You're going to get assessed an over the limit fee. So let's say you have $1,000 limit and you use the card for $500 on something and you use the card for $600 on something. You've used $1,100 in credit. That credit card company will generally let it go through, but they're going to assess you an over the limit fee for going over their assigned credit limit. That can range anywhere from $25 to $50. Balance transfer fees. So that promotional balance transfer that a lot of companies are pushing, where you can transfer your balance to them from one credit card to another and get 0% for 12 months or 18 months. They're going to assess with a balance transfer fee. It's generally 3% of the balance. So if you have $1,000 that you're transferring the balance of, that's going to be a $30 fee. A lot of them do have a minimum fee. So that minimum fee may be $50. It may be $100. And generally, when you look at the disclosures, it'll say either 3% of the balance or $100, whichever is more. And the other fee is one that I mentioned earlier. That's an annual fee. Those can range anywhere from about $50 well on up into the thousands for some of the really high-end rewards credit cards. And, businesses or mass affluent clients who are spending hundreds of thousands of dollars a year, it may be worthwhile for them to pay a high annual fee to capture those higher rates of cash back if they're paying it off in full every month and using it effectively. I think that's all of my slides, but I did want to kind of cover a little bit about credit in general, how it's established and how it's managed. So some of the things that factor into credit score, or what they call a FICO score. It's simply a math formula that factors in several different things. One of those things is your payment history. So if you have loan payment history, credit card payment history, it has to be debt. So like your cell phone bill doesn't report to credit. Your utility bill doesn't report to credit. Your rent doesn't report to credit. None of those things are going to help your credit score in any way. But if you go to a credit union and take out a $2,000 loan, they're going to report to those credit bureaus. The credit bureau is actually charged to report to them. So generally, if it's just an individual or a company where you actually haven't borrowed money and they're making money on it, they're not going to report to credit in any way. When you go to apply for a credit card, the Equifax, TransUnion, and Experian, they charge a fee to the bank for pulling your credit. But what you'll find is over time, that's the next thing that factors into credit. The more on-time payments you make, the more history you make, the more established and the better score you're going to have, and the less it would be affected by something negative. So, somebody with 2 years of credit history with 2 credit cards and 1 auto loan, if they make 1 late payment, that late payment is going to really, really, really affect their score. You're going to see a score drop from 720 to 600, just like that, in one late payment. And by late payment, I mean 30 days late. So companies report to the credit bureaus when you are 30 days late, 60 days late, 90 days late, and 120 days late. Generally, if you get over 120 days late, they're writing that debt off and it's getting sent to a collection company. And then that's reported as well. So when I pull credit, it's going to show, a credit card or an auto loan, and then it's going to say how many on-time payments it's had. If it's had any late payments, it's going to tell me the date of the late payment. And the more recent that it was, the worse it is. So if you had a late payment last month, we're probably not going to give you a new loan because you were just late on a payment last month. And that tells me that you're not able to pay the payments you have. So we're probably not going to give you new debt. One of the other factors in credit score is your utilization of revolving lines of credit. So a bank can offer you a regular line of credit, which is one that you'd have to go into the bank or access online and just transfer the money into your account. Credit cards, and what they call equity lines of credit, which is a line of credit against your house. Those all have what they consider utilization. So basically how much of the debt you're using. So if you have a limit of 10,000, like I mentioned earlier, if you're using more than 30% of it, it's going to negatively impact your score. If you're using over 30%, over 50%, it's going to really start to negatively impact you. But if you stay at 30% or less, it will help you. And so usually what I tell people, if you're going to get a card or you're going to get a line of credit, try to qualify for a balance, or try to qualify for enough to where you're only ever going to need 30% of it. So if I feel like I'm going to use $3,000 a month on a credit card regularly, I'm going to want a limit of at least 10,000 so that I'm not exceeding that 30% rule. One of the next factors is your average age of accounts. So the longer and older the accounts are, the more it's going to help your score. One of the other factors is negative collections or negative, and that can be a medical collection, that can be a Verizon credit card or Verizon account collection. If you go and get a Verizon service, you rack up a $500 bill and you never pay it, they're going to report that to a collection agency who's going to report it to your credit, and that's going to show up whenever I go to pull credit for an auto loan. So that would be a negative impact.
There was something that you said, I know, closing an account is also negative, correct?
It can be. So, when you pay off a loan, you would think it'd help your credit score, but generally it doesn't. And that's mainly because it's going to change your average age of accounts. So if you have an old auto loan and then you pay it off, you're like, oh, well, I'm out of debt of that loan. It should help my score. But then you're losing your regular monthly payment that you'd be paying towards it, which is a factor in your score. You're closing that account, which means that it's no longer open, and so it's no longer going to help your average age of accounts. And so, yeah, when you close an account, it can definitely hurt your score. The type of account and how old it is will determine how much it affects you. So if you open a credit card 1 month and close it 2 months later, it's probably not going to affect you very much. But if you have an account that is 20 years old and that's your oldest account, and then you close it, yes, it's going to have a major impact on your score.
I remember as a teenager, my second job or so, by 17, 18, I got a job at the mall. And the fun thing at the mall was you see everything in the storefronts all the time. And so I got a Sears card, I got a Lane Bryant card, I got a New York and Company card, I got like 4 different mall cards, and I had a blast.
Yeah.
And it was like, woohoo, and then it was like, uh-oh, that, and it might have been $300 and $500 or something like that. And I paid one off and I closed it. And then I learned that you shouldn't do that because it wasn't so. And then after a while, I'd paid them off and then I just left them. And it was like, I was told, like, leave them. And like over time, they will close it off. Like if it's long, like it might be sitting there, the age on your account at a 0 balance might be like 5 or 6 years, but it's better for them to close it than for you to close it.
Yeah, and that doesn't necessarily matter as much. But what you'll find is it is better, especially on credit cards, to let them sit there with a 0 balance and let the company eventually close it out for non-use than it is for you to just go in there and close it. The one common misconception with credit cards in particular is that you have to use it for it to help you. You can go and apply for 100 credit cards, never use them, and they actually will help you more if you never use them than if you do. It's kind of funny. I don't encourage anybody to do that, but I do kind of encourage you to have at least 3 to 5 open lines of credit, because credit takes usually at least 3 to 5 accounts to establish a history. And it's usually not a short period of time that you have to do it. It's usually at least 2 years of 3 to 5 accounts for you to establish any type of good score. You can open up 1 or 2 accounts and you'll have some kind of score, but it can fluctuate tremendously and very quickly based on payment history or utilization if you don't have a lot of accounts. Do you have a question?
Does 3 to 5 accounts mean 3 to 5 credit cards?
I don't necessarily mean credit cards. I mean accounts in general, whether that's some type of bank line of credit, whether that's a credit card, a mortgage, an auto loan. And so long as you have a history of that, it's okay. It's good. You don't need additional accounts. I will say the stronger credits that I see generally do have at least 3 to 5 credit cards that have good history.
Go ahead, Roma.
Sorry, but if you can't get credit, then you won't have a mortgage, a car loan, or any of that. So then how do you get those 3 to 5 accounts if you don't have any of the bigger ones?
Right. So the 3 to 5 cards, you're typically going to have to start out with one, obviously. And that's generally going to be what I talked about earlier, is a secured credit card. So you can go to your local bank or credit union and say, I need help establishing credit. I'm going to put up $500. Can you give me a credit card with a $500 limit? They're going to carry that secured credit card usually for 18 to 24 months. And eventually they'll usually convert that card to an unsecured card and release your money back to you. Usually after about 12 months of having one account, you can go and apply for an additional card, and generally get approved so long as you don't have a high balance on that card that you have. The challenge with low limits with secured cards that I see, perfect example. I have a customer that I just did a business loan application for, and he's in his probably 30s, 40s, late 30s, early 40s. Decent amount of history. I pulled his credit 4 months ago. All he has is one credit card. It has a $500 limit. When I pulled his credit, he has one mortgage open that's good history, and he has one credit card with a $500 limit. When I pulled his credit 3 or 4 months ago, his credit score was 701. Because he didn't have a limit, he didn't have any money on that credit card. He owed like $30 on it. I pulled his credit again yesterday, and his credit score was 675. And the only thing that had changed in between 4 months ago and today was that credit card had a $400 balance on it versus a $40 balance on it 3 or 4 months ago. And it's only $400. And this guy has a $500,000 house. He has thousands of dollars in the bank. He has hundreds of thousands of dollars in assets, but that $400 caused his score to drop 25 points. So
Wow.
and that's going to potentially cost him from being able to qualify for this loan, or qualify for as good of a rate as he could have, because he didn't have enough open credit card accounts to where he could use $400 on one and it not affect him. If he'd have had a $5,000 limit and he put $400 on that same card, his score wouldn't have fallen. But because he has a small limit and he used $400, it's the same amount of debt, but the amount of limit is what affects the score. And it's the utilization of that card that affects the score. So if I'm still sharing my screen, you may be able to see this. This is on Experian's website, and there's a bunch of places where you can find this.
Nope, you're going to have to exit and then share it again, because if you went to a different screen, it's not sharing it.
Oh, okay.
And then you have to reshare. I was going to say, a couple years ago, I was 14 years ago, I was with my mother, and she had a very good job. She had very good income, very good money in the bank, had her house, and we were at Macy's or something like that, and it was a deal if you applied for a card. And I was like, "Go ahead, Mom." I'm like, "You haven't had a credit card in years. Go ahead, apply." She got denied, and she was so upset she got denied for a store card.
Yep.
And she got the letter in the mail. It's because she didn't have
any recent history.
Any recent history, and she was like, "This is insane." And I said, "Well, it's kind of like, I know." And you were saying you can pay it off every month. And I've heard some people say you can pay everything but like $5 or something like that, like leave a little bit of something, but you can pay it according to what you're saying. Like it's like staying at the 30%, staying at that 30, staying low.
Yeah, no. What I would encourage anybody to do is pay it off in full every single month. And usually what I encourage you to do is never exceed 30%, but
right.
I would encourage you to really stay around 10%. And something else is a little trick, especially if you're going to go apply for mortgages or auto loans anytime soon. And let's say you are using a credit card. Let's say you have a credit card that has $10,000 limit on it. You have a $6,000 balance. When your statement drops, the date that your statement drops is the balance and the date that it's reported to the credit bureau. So the credit card's only reporting that balance to the credit bureau once a month. So if you pay off, let's say you have a $10,000 limit, you put $6,000 off on it and you pay it off in full that month, but the statement drops and you have a $6,000 balance, that $6,000 balance is what's being reported to the credit bureau. The next month you put $6,000 on it again. The statement comes out and it shows a $6,000 balance, you pay it off in full. The only thing that credit bureau is seeing is that you're making an on-time payment and that you have a $6,000 balance with a $10,000 limit. They don't see that you're paying it off in full. So all they see is that you're at 60% utilization for 2 months in a row. The trick is, let's say your statement drops on the 20th. Instead of waiting on your statement to drop and for you to get a statement or a bill, you can pay that card in full off on the 19th. And then that statement's going to come out with a $0 balance owed versus a $6,000 balance owed. And that's going to reflect much better on your credit score than the higher balance. So one of the tricks that a lot of folks use is when they use the card, they pay it off before the statement comes out, because you can always go make a payment. You don't have to wait until your payment's due to make it. You can see what your balance is at any given time. So before your statement date or before your statement drops, you can go on there and pay it down, and it'll help your score.
I remember 2 years ago, I paid off all of my credit card debts. It was a phenomenal feeling.
Yeah.
And I kept checking Credit Karma like daily. I was like, oh my God, it's not showing it yet. It's not, because I wanted to see what it would create, you know. And it took a solid month for it to finally go, oh, you've paid this card. And I figured out that it took until that month
Next
cycle,
statement,
because that's when it went through. And I was like, oh my God, this is killing me, because I can't use anything. I can't do any, you know. I was like, because it's still showing that I have this huge balance and I
Yep.
don't anymore. And it was annoying.
Yeah, it
So
definitely can be. You know, and I've seen people go to try to apply for a mortgage. They have a big balance on their credit card because they made some home improvement purchases to fix up their house, and their score drops tremendously because they put a big balance on their credit card. And then they go to try to apply for a new mortgage, and it majorly affects them. They can't qualify. Then they have to make the payment. They may have the cash. They may have $500,000 sitting in the bank. Doesn't matter. They can pay that card down. They still have to wait 30 days for that statement to report the zero balance, and that's going to boost their score back up. The thing about the scores is always fluctuating based on utilization of credit, new accounts, payment history, all of those things. So if you go to Experian's website, I just Googled, you know, what factors into a credit score, but you'll see payment history is 35% of your score. Amounts owed, which is your utilization that I've been talking about, is 30% of your score. Length of credit history is 15% of your score. Credit mix, which is basically the mix of your types of accounts and types of history. So if you have personal loans, mortgages, car loans, the better mix, the better this portion of the score. And then new credit. So the bank doesn't want to see, when they go to pull your credit, that you've applied for 10 cards in the last 6 months. That's not going to be a positive thing that they're going to see. They're going to say, oh, well, they're obviously in a financial position where they need debt, they need credit. So they're usually a higher risk when you need credit. The funny thing about credit is you're a much lower risk when you don't need it than when you do, but you usually only want it when you need it. And so that's why I tell people to monitor it. Some of the tools that you can use, like she mentioned, is Credit Karma. It is a good resource. It's an app you can download on your phone or go to the website. You can answer some questions about your credit history or yourself to sign in, create an account, and it can monitor your FICO score. And it's not going to be, the weird thing is it may not be exactly what the bank is going to look at when we go to pull it. I may pull up my Credit Karma and it show me a 720. I go to apply for a mortgage and I actually have a 740, or I may have a 680. Different formulas are calculated based on the type of credit that you're applying for, but that's getting into way more complicated things than you need to know.
So quick question, being teenagers, you know, like my 20-year-old gets Discover, keeps sending her in a card for students. And I've told her, I'm like, I don't know if I'd go with the Discover card for a first time thing, because they're not, MasterCard and Visa is usually universal. And I said, honestly, Capital One tends to be almost everybody that I know, that's their first credit card when they're getting credit, because they usually approve I said, you know, I got a $500 credit limit when I was like 18 with Capital One. I'd stayed $500 for probably 10 years.
Yeah.
You know, it was insane. It never went up. It never changed for years and years. But that first credit card, is it better, like maybe to go to the bank, like you were saying, like your bank, to have that banking relationship versus
It helps. It helps when you go to qualify for, you know, typically your local bank's where you're going to go for your auto loan. It's where you're going to go for your mortgage. So it helps if you have credit history.
Well, it's where you should go, right?
Yeah.
Like, because if you go to a dealership, you really should go to your bank first and get something, because then you get a lower interest rate.
Generally, yeah. Dealerships tack on what they call a spread to your interest rate. So it's the dealership may put in your application, you qualify for a 3%. They're going to tack on 2%, so they get a kickback on the rate. Whereas if you go straight to your bank, you're going straight to the source. You're not going to get that extra tack on rate where somebody else is making money.
Right. Right. Yeah. So I'm thinking I probably should have her go to the bank and see if she can go ahead and just get a secured card, which maybe would help her first
Yep.
versus giving her full access to a credit card.
That'd be the best way to start. Either that or, an additional user on one of your existing good history cards.
Yes, that was something I was going to ask to Roma. You raised your hand, though. Go ahead.
First off, thank you so much, Matthew. This is a lot of really great information. And even though I'm older than a teen. So Credit Karma, is that like Equifax, or I don't quite understand that.
It's a for-profit company that allows you to monitor your credit through it. So basically what it does is it's going to do a soft inquiry into your credit score from one of those 3 credit bureaus. So it'll actually show your Equifax score and your TransUnion score. So it's going to do a soft inquiry into those 2 credit bureaus to give you a score. Every month it updates. I think it actually updates.
So my understanding is that every time you check your credit, it almost goes against you. Is that?
It has a factor. So credit inquiries and new credit down here, if you look, is one of the factors in your credit score. It's 10% of your score. And whenever you go to apply for credit is when you get a hard inquiry. A place like Credit Karma is only doing a soft inquiry, so it's not affecting your credit in any way. You also have access to go to annualcreditreport.com and access your credit every year, and you can see your full report. And you can see what the banks are seeing when they pull your credit. It's not going to give you a score. It's just going to basically give you all of your history or all of your information.
Yeah, and it's good to do that. It's free. Annualcreditreport.com is free. It's good to do that.
Yeah.
Just because you want to see what's on there, make sure it's all accurate without it harming you.
Yeah.
There are some other agencies that say, oh, get your credit reports here, and they charge you for it. But annualcreditreport.com, I used to have it set, I think it's November every year. Like I could go in on a thing and I could go pull up my credit report, because you want to make sure that everything that's on your credit score is legitimate. Like nobody stole any part of it.
Yeah, I mean, I've seen cases where, a parent or a relative, open an account in somebody's name without telling them. Husband sometimes, or a wife sometimes has opened an account without telling the husband or wife. And, those things happen. So you definitely want to monitor the account. Credit Karma does allow you to do that. So it'll give you a notification every time somebody opens a new account, or every time you open a new account, every time an inquiry happens, it'll pop up with a notification if you have that account and that notification turned on. I encourage you to have that because it's a great way to monitor it. But yeah, it's not going to negatively impact you by having Credit Karma. It's not a hard inquiry into your credit. Hard inquiries are just when you go to apply for new credit.
Okay, thank you.
I think
I hope we have that here in Canada. I'll check into that for sure. The other question I had was about closing credit cards. So I'm having some problems with my MasterCard. So every time I pay it off in full, I want to close it, and then I have a magically new bill. So I'm getting a little frustrated with this, and I wanted to close my account. But you're saying that would affect me?
It will impact you. So one of the factors of your credit history, if you look here, 15% of it is your length of credit history. And so closing an account is going to affect that percentage on the length of credit history. The other one on credit cards in particular that it'll affect is your utilization. So utilization is 30% of your credit history or credit score formula. And so if you have $2,000 available to you on that card and you close it, you no longer have that $2,000 available to you. So your current balance on any other cards are going to negatively impact you. Now, the thing I want you to keep in mind, it's not going to impact you 40 or 50 points. It's not going to tank your credit score. It may only affect you 5 or 10 points, and it's only going to affect you temporarily. It's not a permanent, it's going to lower your credit score forever. Credit scores, as I mentioned, are always fluctuating based on, new accounts, utilization, inquiries, all of these things are impacting them every single month. They're always fluctuating. They're going to go
So
up,
if,
they're down. Don't live and die by your credit score. Pay attention to it, monitor it, do the things that I've talked about that help your credit score. Go do your own research as well. There's a ton of resources. Dave Ramsey has a lot of resources. Experian, Equifax, TransUnion, all on their websites have a bunch of resources on how to manage your debt effectively, help your credit scores, things like that too.
so if I no longer want to use that card, I'm better off just bringing it to a zero and opening a new card and using that one.
Yes, pretty much. It's gonna avoid a negative impact to the score, to your credit score. Now, if you have a company that's charging you excessive fees, you're just randomly getting charges for some reason, it's been hacked, different things like that, it's worth closing it. It's worth taking the hit to your credit score to get out of that situation. If you're a person that can't manage your, and I'm not saying this about you, but just for other people, if you're a person that continually resorts to using a credit card when they shouldn't, and you continually get yourself in a poor position financially because of it, you're better off not having a credit card than having them and putting yourself in a negative position. I encourage everybody, only keep a card open if you can effectively manage the limit that's available to you.
So even, I guess, if I'm having a problem with the credit card company, so I've been hacked a couple of times. I just keep getting all these charges. Is there anybody I can talk to about that? Because I'm definitely not getting answers from MasterCard. So if I want to close that, can I talk to maybe Equifax or something and saying they don't care? I see you nodding. Or can I talk to Equifax and just say that I've got this problem? This is the reason why I'm closing.
They may advise you on what to do, but it's not going to matter as far as your score. The score is a math formula, and the math formula doesn't care what the situation is, unfortunately. Right. Okay. I would just encourage you to close it. It may negatively impact you 5 or 10 points for a little while. Go open a new account. Never think about it again. Don't worry about it. It's not a big deal.
I would think that too, especially since if you're being hacked. I think it's you're and
it's been ongoing. So yeah, okay. Thank you for that information. The other thing, I feel like I'm getting myself in trouble here, but I pay my credit card off in full, but I do it every other month. Is that bad?
So you're carrying a balance for a month?
Yeah, I guess so.
I mean, it just means you're paying interest. So if you carry that balance for a month, you're going to get charged interest that month. And then when you pay it off in full the following month, you're not getting charged that month.
But is that affecting my credit?
Not in any significant way, no. Because as I mentioned earlier, the balance that's on your statement is what's being reported to the credit bureau. So that balance is reported every single month. The only thing the credit bureau sees is your balance and if you make a payment. They don't see how much of a payment you make. So on a credit card, they're going to get a check mark for your payment being made so long as you make your minimum monthly payment, and they're going to get the balance that's on the statement reported to them. Okay.
Thank you. Also, I just wanted to say that was a great tip on the buy later. I always knew that it was trouble, but I never knew why. But I didn't realize that interest is then accrued for those 6 months of pay later. That's crazy.
Yeah, I mean,
thank you.
they can
You've
be handy
been
to take advantage of, but just be careful to make sure you pay it off in full because they can back charge you the interest. There's been
yeah,
a
I've
few
never done
lawsuits
that.
about it, but they'll do it.
Yeah, I've never done it because I've always heard it was bad, but I didn't know why it was bad. But thank you. This has been so helpful to me. I can't even imagine. This must be a little overwhelming for teens. Just be good and you'll be fine.
Yeah.
Thank
Um,
you.
What I had a teen that that was aging out of foster care years ago, and at 17 you had to bring them to the facility and we'll just say the DSS office, and they sat down with everybody that was on their case plan, everybody, and they went through, and it was like a 3 hour long meeting, and they went through of all of the things. Let's make sure you have this in place, and do you have this in place, and if you were to die, who is your beneficiary, and what do you think about it for, and it was all the adult stuff. And I could just like look at her and I could see her going like, what the
Clueless.
heck are
What
you
the
all
heck's
hitting
going
me
on?
with?
Yeah.
You know? And I was just like, I get that this is they're still trying to have fun in life and they're still trying to enjoy life. But sometimes you need to have a little bit of this. And I would even say like this is always recorded. So like, you can look at over this again. Like if your teens some of you had like 12 and 14-year-olds or 14 and 16-year-olds, you can look over this again later on with them, pull up the video, play it again, when they have a question on it. It's just because sometimes we need to have that understanding again of this. And I like what Matt was saying about don't let some of this stuff control you. Like sometimes like as teenagers we think, oh my gosh, we were supposed to be really because Credit Karma, like Roma, just so you know, like I use it to keep track of my credit scores and just keep track of where everything's at, and I'll send you emails for this and that, and I don't do any of that stuff. But I have learned that they like to really send you emails and go, hey, did you look at your score today, and hey, this might be a problem, or hey, this, and they like to really get you hooked. And at one point I was like, all right, I'm done. I can't look at any of their emails for 30 days because all they want you to do is just pull you in to like obsess over this credit score thing. And I was like, I'm done.
Yeah.
I'm not needing anything right now. So
I've seen folks get carried away, monitor it, and stress about it. Anything that becomes a point where it's a stress point for you, time to step back, reevaluate what's important. It's the funny thing is the credit score is actually very easy to manipulate, both good and bad, because it is nothing but a math formula that's factored on these factors here that I showed you. So you can, go in there and pay all your credit cards down and it's going to boost your score. You can go in there and use all your credit cards and it's going to lower your score. You can go and apply for 10 different accounts. It's going to lower your score. The crappy thing is it's much easier to negatively impact it than it is to positively impact it. Because typically the only thing that positively impacts it's time and good history.
and I find it interesting is like, you really need to be a good person. This is what your parents raise you for, is to be a good person and to be responsible. And like it actually matters in the real life because this is what they're looking for is are you being good and responsible? So it's like, oh, I really am supposed to listen and do things and pay things on time and do things when they're needed and not live beyond my means. Oh yeah, like that's what my parents always said, but I thought I could be an adult and do it my own way. So it's kind of like, nope, these organizations exist because they want you to do that. So
Make
any
lots of money, hundreds of billions of dollars.
what was it when at 107 was it?
I think it was $107 billion in interest that was paid by the U.S. Citizens in 2021 in interest. And for the first time in history, the credit card users, more than 50% of credit card users were not paying their balance off in full every month for the first time in U.S. history. There's also the largest credit card balance in U.S. history right now as well, which is not a good thing.
Right.
More than 2008?
Yes.
Wow. Yeah.
Wow.
So one quick question just to throw out there. I have always heard that a lot of times credit card companies can see what you're buying and they can kind of judge how like if you're buying groceries or you're paying the electric bill or you're buying things that are like everyday things, that they can kind of tell like, oh, they're not doing well? Or is that something that's a myth, or is that like, is there
They
any?
can they can definitely tell what you're buying because every time you swipe your card, that merchant has a merchant code. That's why that's how they categorize for rewards in particular. So like if you see where they're going to give you 2% back on groceries, they know when you're buying groceries because when you swipe that card at a grocery store, it's got a merchant code that's assigned to it that's assigned to grocery stores. When you go to swipe it at a liquor store, they're going to know that it's a liquor store that's swiping that card because it's assigned to a liquor store. When it's a toy store, they're going to know where you're swiping your card at. As far as how much impact that has on any decision making they have, I don't know of any.
Right.
I don't think that can actually be a factor in anything that they do.
Okay. All right. Anybody have any other questions? We usually stay to an hour, and this is oddly enough on Credit Score. We have gone over an hour here by 20 minutes. So anybody have any other questions? Otherwise, I was going to go ahead and wrap us up. We've gotten a lot of thank yous, Matt. I don't know if you've seen that in here. Roma said, thank you. This has been incredibly informative. Thank you so much, Christina and Matthew. Wish I had this 40 years ago. Yuri, I know, was asking if we could have this in Spanish. And Yuri, I am trying to launch a Spanish division of Atlantic Institute. It's been a little bit more challenging than I thought it would be, but I would like to start providing some dialogue events in Spanish. So I am working on that. And Argelia said, thank you so much for this information. It's very helpful so that she can relay this to her kids. Tabitha said, great session. Thank you, Matt Fowler, and thank you, Atlantic Institute and Christina. So we've gotten quite a bit of thanks for this.
You're welcome. Thanks for joining us.
So thank you very much for joining us today, Matt, and speaking. All right, so I'm going to